Good morning, everyone. This is a live daily market outlook from Windsor Brokers for Tuesday, 24th of July, 2012. The main characteristic of the past couple of hours movements from the opening of Asian session and this morning start of European is a rather consolidative mode after heavy movements seen in past 2 days when Euro posted a fresh two-year low at 120.67 and sterling dipped below psychological 155 level. Dollar Swiss is pardon, also in the corrective consolidative mode of 99.50. It's yesterday's peak, however, still holding above 99.00. That keeps the positive tone in play. The Aussie dollar jumped higher after suffering heavy losses and dipping below 200 days moving average after Chinese PMI data that came last night and showing the result the highest level in the past 5 months. The crude oil is attempting to find base at current levels of around 88.80 zone after dipping to 87.77 on the strong pullback from 93.22 last Thursday's high. This morning is supported by positive Chinese data. The gold remains still fragile, unable to break 1600 barrier and still a negative structure seen on the short-term studies keeps the downside for now more vulnerable. As said, the top release of today is the Chinese flash factory purchasing managers index that rose in July to its highest level since February, boosted by a pickup in output and signs of improvement in new export orders that offered relief to struggling financial markets. HSBC's flash China manufacturing purchasing managers index rose to 49.5 in July from 48.2 in June, rising close to the 50 level that divides expansion from contraction. The increase was driven by a jump in the output sub-index to 51.2, the best showing since October 2011. Basically, this release gave some boost to Aussie dollar as well as crude oil. However, the near-term outlook is still rather negative regarding crude oil and euro, and more of this we are going to see on our technical part. From today's calendar, number of PMIs due to be released, starting with Germany at 7:28 GMT. Manufacturing PMI for July is expected slightly better at 45.3 compared to 45.2 June's release, well below 50 mark, while flash services PMI for July sees according to today's forecast, move above 50 barrier. 50.1 is the consensus compared to 49.9 release in June. Brief, small improvement, however, still moving above 50 would give a good signal of possible further recovery of German economy. Eurozone's PMIs are due at 7:58 GMT. Manufacturing PMI forecasted at 45.3, slightly above 45.1 release of June, while services PMI is also expected to tick higher to 47.3 compared to 47.1. Across the Atlantic, Canadian retail sales due at 12:30 GMT, a 0.3% increase compared to a negative 0.5% release of month of April, while core retail sales are also expected to show some improvement in May. 0.2% is today's consensus compared to minus 0.3 in April's release. Ben Bernanke, Fed chairman, is due to speak at 12:45 GMT, while the U.S. manufacturing PMI due at 12:58 GMT. Release for July is forecasted at 52.2, slightly below June's release at 52.5. U.S. home price index due at 1400 GMT, again decrease to 0.5% forecasted for today compared to 0.8% of April's release. U.S. Richmond Fed Manufacturing Index for July is expected to stay unchanged, with some releases seen. That will be already the next day. Trade balance of New Zealand and Japan. From the markets that we are going to take a look, most of you are looking for the technicals to see the potential expectations and potential movements for today. We're going to start with Euro as no top performer, I would say, seen in past 24 hours, as single currency is currently consolidating the past 2 days drop from levels at above 123 that dipped to 120.67, dangerously approaching our downside target, and strong psychological support at 120.00. And not much was seen of the corrective action, as 121.40 zone so far capped the upside and failing to fill the yesterday's gap lower when the market opened at 21.20 compared to Friday's closing at 121.63. The pair was still short 20 ticks to cover the gap. Also descending a 55 days exponential moving average currently at 121.30s. So far maintaining the downside. Holding above 121, that still stays intact, keeps hopes of possible further recovery, as the pair again gains momentum despite some weakness seen in the early hours of Europe when the pair dipped down to 121, but holding above this significant support still keeps chances of stronger correction of past 2 days descent. A regain of minimum 121.55 and 121.63, the closing of the last weeks, is required basically to fill the gap and break above 121.80 high, intraday high of 20th of July, along with the 122 zone that is also close to 50% retracement of the down move from 123.22 to 120.67. Would allow for some stronger recovery and prevent pair from further slide. At least they will delay the weakness, as larger picture still shows bears firmly in play, with the latest bounce seen just as a brief consolidation. Also 121.69 reinforces the descending 20 days exponential moving average, reinforces initial 121.50, 121.80 barrier, along with the 122 and 122.33, where is the descending 55 days exponential moving average on the 4-hour chart. Our main barrier in the short term remains at 123.20 zone, and basically only break above this level would provide a short-term relief and allow for a stronger correction of the larger down move from the latest down leg from 126.91 29th of June 2012 peak that dipped so far to 120.67. However, still the negative tone sees the downside more favored, and unless one minimum 123 zone is regained, more focus would be seen towards the downside, with a break below 120.67 yesterday's low to open 120.00, our short-term target, and a very significant psychological support, as daily studies are firmly bearish and continue to point lower despite approaching oversold zone. Not much is again to be seen unless 123.20 is regained. This is also reinforced by descending daily 20 days simple moving average. Similar to Euro, cable undergoes brief corrective consolidative action following a slide from last Thursday's peak at 157.36, where the pair failed short of important and strong barrier at 157.50 zone, where it's currently 200 days moving average that keeps the upside capped from mid-May 2012, and the latest attempt higher again ran out of steam just on approach of this level. 157.36 was seen ahead of a sharp slide. More focus into the downside, as not much so far seen of the corrective action of 154.84 as the pair yesterday briefly broke below psychological 155 level with the 155.34 seen so far. This is also being capped by descending 20 days exponential moving average as shown on the hourly chart. As long as 155.80 that marks a previous low of 18th of July, as well as 38.2% Fibonacci retracement of down leg from 157.36 to 154.84 stays intact. I would say the current move would be seen as corrective, and preceding fresh weakness. More risk again is seen towards the downside as most of the indicators are holding in their negative territory, as well as daily studies breaking below the midlines, keeping more focus towards the downside, and looking for test of very strong supports at 154.60, 6th of July low, 154.20 main bull trend line connecting 152.67 and 153.92 lows, a loss of which will open way towards more significant 154 level, a low of 12th of July, also marking a short-term range floor, loss of which would turn the short to medium term structure more negative for possible extension towards yearly low at 152.67. More focus, as said, seen towards the downside with loss of renewed weakness below 155 to focus immediately 154.60 and 154.20 trendline support ahead of the most significant short-term level at 154 zone. As said, on the upside, regain of minimum 155.80 and more significant psychological 156 support would revive. The regain of 155.80 would prevent pair from further slide, while break above 156 as a break point would revive bulls and allow for a stronger retracement of the latest 157.36 to 154.84 descent. The dollar yen enters sideways movement, but outlook is still seen more negative as studies are aligned more towards the downside after a bounce of yesterday's fresh low at 77.93 when the pair briefly broke below 78 handle. Did not show much as gains have been capped by descending 55 days exponential moving average at 78.45, equivalent to the previous low of 19th of July. This was basically acting as our initial resistance ahead of more significant 78.80 and 79.00 that marks the previous range floor, as well as 200 days moving average as shown on the daily chart. As long as holding below these levels and the initial support at 78.45, more risk is seen again towards the downside as studies on the 4-hour and the daily are still quite bearish and keep the downside firmly in focus. Loss holding above basically 78 level as our initial support, with 78.15 seen late yesterday as the lowest following a bounce of 77.93, would keep probability of possible further consolidation and the narrow range movements, but only break above 78.40 and more 45, pardon, and more significant 78.80, 79 would bring a more positive tone into the current negative structure, while a loss of 78.00 and 77.93 yesterday's low would risk further extension lower and a possible test of our key short-term support at 77.65 low of 1st of June 2012. That will signal continuation of the larger downtrend from 84.17 yearly peak posted on 15th of March 2012. The dollar Swiss continues its short-term consolidation following pullback of yesterday's 99.50 fresh high. This level also marks 61.8% retracement of the longer-term downtrend from 117.30 to 70.67 ahead of more significant barriers at parity level, and 10046, where is 200 days moving average. Near-term price action is still seen quite positive, as the downside remains supported just above our break point at 98.70 zone, at finding a ground at 98.87. This is the low of yesterday, and currently hovering around 20 days moving average in a rather sideways movements. It's important that price action holds above 98.70 zone, as this marks the break of which will mark the filling yesterday's gap, last Friday's closing price, as well as previous peak of 13th of July at 98.71, and the loss of this would delay immediate bulls and allow for a stronger corrective action of the latest uplift from 97.45 that peaked at 99.50, with the support being reinforced also by 38.2% Fibonacci retracement of the uplift, currently at 98.72, along with the ascending 55 days exponential moving average at 98.80. So the main risk would be seen on the break below a 98.80-70 zone. That will allow for a stronger correction, with the 98.50, 50% and 98.20 zone that marks 61.8% retracement seen as the next target in case of break lower. Otherwise, as a positive tone continues to dominate still on the 4-hour chart, and some improvements as hourly studies started to point higher. More focus at this point is seen towards the upside. However, clear break above 99.50 is required to signal the resumption of the broader uptrend and the open way towards our next upside targets at parity and 10046 200 days moving average. The key short-term support lies at 97.45, and basically break of this level would put bulls on hold in favor of a stronger corrective action of the larger up move from 90.41 to 99.50 so far. As said, the crude oil got some boost from overnight Chinese data, but so far this seems to be short-lived, as the pair yesterday dipped to 87.77, and the overnight recovery reached a level at 89.00. Still negative tone seen dominating on the 1 and 4 hour charts, as the pair unable to clear 55 days exponential moving average on the 4 hour chart. Seeing potential for a further easing, further correction of the larger up move from latest leg from 77.27 to 93.22. That was the high of last week. As so far support was found, as said, at 87.77. Failure to break higher and clear the previous highs at 89.36.76, where is also the 20 days exponential moving average. Would see risk of possible further corrective action, with the Fibonacci 38.2% at 87.13 seen next, ahead of static barriers at 86.46 previous range top, and the 85.25 that marks 50% retracement. I would say critical support for the near-term action is seen at 83.64 and 83.36 previous range floor, and 61.8% retracement, a loss of which would sideline short-term bulls and open way for a deeper reversal and keep the upside protected for the time being. Immediate bounce and break above 89.76 and 90.00 would turn the short-term focus again higher, as break here would be initial signal of base at 87.77 for possible extension towards last week's high at 93.22. Overall picture is still the larger picture still keeps some positive tone despite the current pullback, and it's also supported by current fragile situation in the Middle East, especially in the Gulf region, tensions with Iran and the problems with Syria, that with the recent conflicts in Turkish-Syrian border, registering some damages on the pipeline that might more significantly disrupt the supply. That will be immediate push for the oil price. That is already well supported by negative news and the fundamentals that are coming, especially the current instability and unstable situation in the Middle East and the Persian Gulf region. That was all for today from our side. Now it's time for questions and answers. Please submit your questions right now in written, and I'll be glad to answer. We have the Aussie dollar, as it became our standard. I think the pair is still in the short-term, near-term down move of recent peak at 104.43, with the situation on the 1 and 4 hour chart still maintaining a negative tone, as the recent pullback retraced nearly 61.8% of the latest upleg from 100.99 that peaked at 104.43, hitting 102.42 just ahead of 102.30, the 61.8% retracement. As current congestion seen at levels just above 103, where the pair was unable to break higher, and the price being capped by descending 55 days moving average. Immediate risk would be seen of further extension lower. Of course, loss of 102.50 and 102.42 levels is required to confirm. Some more positive tone seen on the hourly chart, as the indicators are still ascending and gaining momentum, but clear break above 103 zone would be a signal for a stronger action higher. Otherwise, more focus, as for our indicators are well in the negative territory, would be seen on the loss of recent low at 102.42 and 102.30, Fibonacci 61.8%. That will allow for deeper reversal, as previous peak and a strong strong support at 103.26 has now been lost, and the pair is struggling to basically regain this level. Firm lift above 103.26 would slightly improve the structure. Otherwise, more risk, I would say, at this point would be seen towards the downside, despite overnight Chinese data that gave a great boost to the Aussie dollar, but it seems that initial optimism is now fading. If we don't see clear break above 103.26, then risk will be still seen towards the downside and possible test of 102.50, 102.42 lows. Any further question? We have a question for gold. I think we missed it today. Okay, as mentioned at the beginning of the session, the situation on with yellow metal remains fragile after yesterday's dip to 1563, although some quick recovery was seen back to 1580, but the tone is still dominating tone is still negative, as studies still point lower, and the MACD holding below the midline. The other indicators are already pointing lower, with the 55 days exponential moving average on the hourly chart so far capping the upside and turning more focus towards the downside. Situation on the 4 hour chart is also seen quite negative, following the recent upside rejection at 1598, just a few ticks below 1600 as our break point, reinforced by 61.8% retracement of the down leg from 1624 to 1554. As said, more focus, I would say, at this point is seen towards the downside, as long as initial barriers at 1580, 1587, 1590 hold. The upside ahead of more significant 1598, 1600, and only break above this level would bring some more positive tone into the picture. Otherwise, risk is seen towards yesterday's low at 1563 and more significant 1554, 1548. That loss of which might open way for towards critical support, long-term critical long-term support zone at 1530, 1520. If there is any other question, please. Okay, it seems that we exhausted our questions for today. In that case, I would like to thank you all for being with us. Expect to see you again tomorrow at the same time at 7:00 GMT, when is our regular English daily market outlook is due to start. Until then, I wish you a nice day and very successful trading. Good luck.